Welcome to Deception Reports. Today, we're uncovering the true story behind one of the biggest financial collapses in American history. Lehman Brothers was a 158-year-old Wall Street giant, but in 2008, it collapsed in a single day. This is not just a bank failure. This is a story of deception, greed, and a system that lied to itself. On September 15, 2008, a 158-year-old Wall Street giant collapsed in a single night. No bailout, no rescue, no warning to the public. Lehman Brothers, a bank that once controlled over $600 billion, filed for bankruptcy and took the global financial system down with it. Within hours, stock markets crashed. Credit froze. Businesses couldn't borrow. People lost jobs, homes, and pensions. This was not an accident. This was not bad luck. This was a controlled demolition, built slowly through greed, leverage, deception, and regulatory blindness. Tonight, you'll see how Lehman Brothers didn't just fail, it lied until the very end. The illusion of immortality. Lehman Brothers wasn't supposed to die. Founded in 1844, Lehman survived the Civil War, the Great Depression, 2 world wars. By the early 2000s, Lehman was a Wall Street legend. Inside the firm, there was a dangerous belief. We are too smart to fail. Executors believed risk could be engineered away, that markets always recover. That leverage was a tool, not a weapon. That belief would destroy them. The new Wall Street game. In 1999, everything changed. The repeal of the Glass-Steagall Act removed the wall between traditional banking and high-risk trading. Banks were now allowed to borrow more, trade more, and gamble more. Lehman didn't hesitate. They dove headfirst into subprime mortgages, mortgage-backed securities, and collateralized debt obligations. These weren't traditional loans. They were financial bombs disguised as safe investments. Lehman loaded its balance sheet with them, and then it pulled the trigger with leverage. Quaranta 2-1 the suicide ratio. By 2007, Lehman's leverage ratio crossed 40-1. That means for every $1 of real money, Lehman borrowed over $40. This was not normal. This was not safe. This was reckless. At T's level, a loss of just 2 to 3% could wipe out the entire firm. But executives ignored the math. Why? Because bonuses were tied to short-term profits, not survival. The housing crack in 2007, U.S. housing prices stopped rising. Then they fell. Then they collapsed. Subprime borrowers defaulted. Mortgage securities lost value. Lehman's assets began routing in real time. Internally, risk managers raised alarms. Executives dismissed them. Instead of reducing exposure, Lehman doubled down. And when reality became impossible to hide, they turned to accounting deception. Repo 105 hiding the body. This is where Lehman crossed the line. Repo 105 was not standard practice. It was a deliberate manipulation. Lehman temporarily sold assets before reporting periods and classified the transaction as a sale instead of a loan, and removed tens of billions in debt from its balance sheet. Then, days later, they reversed it. The debt came back. The risk never left, but investors never saw it. This wasn't transparent. This was camouflage. The firm looked stable. In reality, it was already dead. Auditors, regulators, and silenced Lehman's auditors knew. Regulators saw warning signs. No one stopped it. Why? Because the system trusted big banks. Regulators feared market panic, and everyone assumed someone else would step in. That assumption was wrong. The final weekend, September 2008, confidence evaporated. Counterparties pulled funding. Lehman was bleeding cash by the hour. Rescue talks collapsed. The U.S. government refused a bailout. British regulators blocked Barclays. Bank of America walked away. At 1:45 a.m. on September 15th, Lehman Brothers filed for bankruptcy. 158 years. Gone the shockwave. The fallout was immediate. Money market funds broke the dollar. Credit markets froze. Global trade stalled. Trillions vanished. Millions lost jobs. Entire economies entered recession, all triggered by one institution that chose deception over discipline. The real lesson: Lehman Brothers didn't fail because it was unlucky. It failed because risk was rewarded, truth was hidden, oversight was weak, and greed was normalized. This wasn't just Lehman's crime. It was a systemic failure, and the most dangerous lie of all. That it golden tea happen again. If you want more real stories of financial crime, corporate deception, and Wall Street scandals, subscribe to Deception Reports. Because the truth is always hidden in the numbers.